In this video, traders, we're going to look at risky markets to trade. Stay tuned. Hey guys, warm welcome to you. So, you want to know if you've watched any of my videos, the first thing I'm going to say is really boring and say, hey, all markets are risky. If you're trading euro, US dollar, you can lose all your money. And that's basically true. This is a little bit of a tongue-in-cheek video because all markets are indeed risky. As I say, we could be trading the thickest, most slowest moving thing ever. But if we're heavily sized, and if we're trading too much, we're trading all that kind of stuff, we're going to lose our money. But putting all that stuff aside that we talk about regularly on this channel for one moment, let's look at some of the most risky markets to trade as seen by some hedge funds who've blown up. We'll talk about those in a second. As seen by traders who have always seemed to be caught out on these. And we'll look at each of these. I've got 8 of them at the moment. If you've got any more, stick them in the comment section below. And let's go. Right, number one, natural gas. Natural gas has wiped out its fair few traders and funds along its way. Good old natural gas. We had Amaranth in 2006, I believe. They blew up on natural gas. We've had a recent small kind of fund, or really advisory firm that was managing multiple accounts, done a video on that, go and check it out, blew up almost 100 million, allegedly trading natural gas. And you can see why. It kind of sits and does nothing, and all of a sudden it just goes bang, or just rockets up to the upside, rockets to the downside. There's these supply demand imbalances sort of sitting there. Everyone's happy. There's loads of supply coming in. There's loads of demand, or should I say it's even. Then all of a sudden, you know, wham, there's some sort of supply cut off, there's some sort of demand coming in, there's some sort of weather front coming, and all of a sudden the whole thing just messes up. And of course, everyone is just scrambling for front month contracts. They just want the gas because they need the gas for whatever reason. Obviously, heating's pretty crucial, whether you're someone sitting in your house, whether you're somebody trying to heat or use the fuel for a factory, or whatever other reason you're using natural gas for. You can see why all of a sudden you need it at whatever price it is. And these spikes cause people to just completely blow up because they don't see them coming. Well, they don't see them coming, but we seem to have them every kind of 10 years, and they take out quite a lot of people. So natural gas is known as a bit of an animal. It's funny because actually, if you started trading probably, let's say 3 years ago, you look at the chart and you go, why? Doesn't even look anything, it's boring, don't touch the thing. But if you kind of got to scroll back and look at it, it does have these crazy spikes. So natty gas, number one. Number two, crude oil. Similar to natural gas, most of the time it's pretty, you know, stable, and it goes through phases where it just sits there and people are churning out barrels of oil, people are consuming barrels of oil. It goes up a little bit with demand, goes down a little bit as the global economy lifts up, oil price lifts up, and all this kind of stuff. But every now and then you get a similar thing to natural gas, not quite as exaggerated, but you do often get this where, you know, supply is choked off for whatever reason, demand is shooting up, and it creates a massive supply imbalance. And if you think about commodities in general compared to, say, stocks, people have to have commodities to function, i.e. to heat something, to fuel something, to feed something. And if they don't have it, they're going to have to pay whatever. It still needs heating, fueling, running. Whereas a stock, if you just don't need it, you're not going to buy it. You don't need to buy a stock. There's no necessity to buy a stock, which is why sometimes we get these supply demand imbalances that are so huge in the commodity markets, specifically energy markets like natural gas, like crude oil. Next one, of course, is VIX Volatility Index, or Volatility Futures, whichever one you look. VXX is the ETF for it, or the Volatility Index, Volatility Futures, the volatility component of the S&P 500 options. Pretty interesting because this is really a human emotion. You know, if people are perceiving that, hey, this thing's going to be volatile, and they're kind of scrabbling for insurance, i.e. perhaps they're buying puts on the S&P 500 or SPY or whatever it may be, you will see VIX spike up. And it's self-fulfilling prophecy. People see VIX spike up, people get more concerned, and the chart will just kind of look, if you know, look at it, it kind of does this, spikes up, comes back down again, sits there for a long time, and spikes up and comes back down again. And generally people are shorting VIX because they think that little short-term spikes in volatility will fade away. And they do, 9 times out of 10 they do. But every now and then someone hits a short on VIX, and it goes up kind of 10, 15 times what they expected, they get wiped out. Similarly, the same kind of thing with the long VIX trade. The long VIX trade seems to be the kind of obvious one. You're like, well, we're going to get this at some point, so surely I may as well stay long VIX and wait for the spike. You know, VIX is not going to go to zero. It kind of drops to 10 or something as the lowest, or 11, 12, 13, that kind of thing, and then pops up a little bit. So a long VIX seems like a great trade. Yes, until you see that this thing can stay stagnated for ages. The rollover costs are expensive. It's an expensive trade to do. And you then sit with it, go, well, I'm waiting for the volatility expansion, and you're kind of stuck with it. And then maybe it comes, maybe it doesn't, but by that time, you've probably spent so much money rolling the trade over the futures months that you've missed out on that big spike anyway. So VIX is another risky market to trade, especially on the short side in terms of loss, but also on the long side in terms of how long it takes potentially to see these massive spikes. Right, number 4, the triple leverage ETFs. These are relatively new concoctions that have come out, which are triple leverage. In other words, they will mirror the move of an underlying times 3. So underlying goes up by 10%, the triple leverage ETF will go up by 30%, and they can be inverse as well. So if the underlying goes up, the ETF goes down. If it's triple leverage, goes up by 10%, triple leverage goes down by 30%. So you can see it's just amplifying the moves. And they're there for people who don't want to trade on margin, but kind of get the margin wrapped into the vehicle. So you can trade that with pure cash. You put 10 grand in rather than having to trade on margin, and you get 3 times the move. Now, there's not a video on ETFs. There's lots of costs involved with that. But the point is, because of the way they're structured, obviously they're super volatile, which catches people out because they sit there and do nothing, and all of a sudden they become crazy volatile. They can be expensive as well because of the management fees in them. They're just generally a risky market to trade. Some day traders love them, some swing traders try to get in, but more often than not, these kind of catch people out a lot. All right, number 5 is the Japanese government bonds, specifically on the short side. Now, I'm going to do a video, go and check it out, probably already uploaded this, about this trade, which is called the Widowmaker, for reasons that we'll go into it in the video. So, hit the subscribe button and kind of look around and see when that comes up, if it's not up already. But really, this is known as the Widowmaker because a lot of hedge funds have got involved in it because the theory is right. They're waiting for the trade to actually come good, and it never does, and it costs them a fortune to trade it and all this kind of stuff. But that's another risky market to trade. Interesting kind of story behind that. Anyway, number 6, developing countries. Pretty self-explanatory. If you're trading Venezuela as compared to the US, there's a really hefty risk premium on that because you just don't know where it's going to go. The political impact of things is massive. There's potential corruption in these countries. There's all sorts, and I'm just picking Venezuela as an example of a country that is developing, that hasn't perhaps got the infrastructure there, the legal system, there's corruption everywhere, of course, but the level of corruption is higher, potentially affecting the value of your asset, the value of your investment. And so when people are trading in these kind of countries or specific stocks in these countries, if you have access to them, some people do via specific ETFs. They've got some in ETFs. Some people do go directly and trade bonds and what have you, all that kind of stuff. Massively risky type of thing to be trading. Number 7, biotech small caps. These things are ridiculously risky as well because liquidity is low, the market cap is low, and they come out and they say, hey, we've had a really good news for this drug, and the thing will just shoot up 200%. Now, sometimes you can't borrow them short, but the other thing is going long and short. Both these things are super risky. People pile in, they read the news, they read the RNS release, and they go, yeah, that looks great, they buy it. Next thing is the whole thing's worthless because it turns out that it wasn't quite true. They mistyped it, all this. I mean, I'm exaggerating slightly, but that feels like what it is. And if you look back at some of biotechs before they eventually go bust, 1 in 100 or something may well make it and chug along and make some money and become a decent stock. But often these things are up 50%, up 100%, up 1,000%, down, and run out of money and they go pop, and it's just a vehicle for just a mess generally. So they're super risky, those kind of things. Final thing here, guys, number 8 is the same kind of theme, but I wanted to put it in here. Over-the-counter / penny stocks. Over-the-counter stocks don't have the same kind of rules as the traditional big exchanges like London Stock Exchange, NYSE, NASDAQ. OTC is really a US-based stuff, but it doesn't have the same rules, doesn't have the same reporting rules. It's a vehicle and venue that they can trade without being super regulated, and you kind of understand it helps people without the the red tape get on some venue where they can exchange shares. But there's a big caveat because there's a lot of stuff going on in those areas, which is just super risky. The companies aren't viable. And yet, you know, there's like we go back with the biotech, there's going to be a handful that eventually will kind of make it through onto the proper exchanges, so to speak, and make a good business out of it. But there's a lot of stuff going on there, a lot of smoke and mirrors, cloak and dagger stuff, which makes these OTC and penny stocks really super risky to trade, because at any point the rug can be pulled, you can lose all your money if you're shorting these things, which can seem like the most sensible thing to do in inverted commas, because it goes up 200%, you want to get short on it. If you can borrow the stock, great, you might be able to get it, but then you've got the chance of it going up another kind of 200 or 300%. These are the order of magnitude of moves that you get. Of course, going to rip your face clean off if you're short on that. So super, super, super risky. Anyway, guys, those are 8 risky markets to trade. If you've got any of your own, stick them in the comment section below. Appreciate your support if you're a subscriber. See you next one. Take care. Bye-bye.